This is the chapter 9 and 10 synopsis. Now, I didn't pull up the slides for chapter 9 because, excuse me, I'm just going to focus on a few things that are relevant to the test questions. Uh, you don't have to go over all of the different types of insurance. There's private insurance, there's insurance through the Affordable Health Care Act, there's Medicaid if you're low income, there's Medicare if you're 65 and over. You can skip all that. What I want to talk about really are just three things for chapter 9. The first thing is the fact that insurance is very expensive or that healthcare is very expensive in this country. And what I mean by that is we spend more on healthcare compared to most developed countries, most Western European countries. And so look in the slides and look in the book and read, why does the US spend so much more on healthcare than other countries? Well, one of the reasons is the aging. One of the reasons why we spend more on healthcare than compared to some other countries. And one of the reasons why healthcare costs have gone up so much, one of the main reasons that you don't really hear about is because of the aging of America. We have an older population, and an older population means a sicker population. Most people go their whole lives without needing significant medical care, and then towards the end of their life, they need a lot of medical care. So the majority of medical expenses that somebody incurs is later in life. So when you have an older population, you're going to see higher, more healthcare spending, higher healthcare costs. Also, technology increases in advances in technology have made procedures more expensive. That's another reason. So anyway, those are the two main ones I wanted to talk about. But make sure you read the section in the chapter and in the on the slides about the healthcare costs for US versus other countries. All right, then the next thing I wanted to talk about is COBRA, COBRA. That's not, I didn't see that in the slides. I might have missed it, but it's in the book. And I just wanted you to understand what COBRA is. It used back before COBRA, which is uh, it's a government regulation. If you quit your job, you would lose your insurance, and or quit or got fired, whatever, laid off, what have you. You wouldn't have any insurance, and you would have to scramble and try to get insurance. So a lot of people, it caused a hardship for a lot of people because let's say you were just in between jobs and you would lose insurance. So COBRA allows people to keep their insurance from their former employer for a specific period of time. It's usually around 6 months. So if you quit your job, get fired, get laid off, you can use COBRA to keep your insurance. And so that's mandated. It's a federal law now. Now here is the disadvantage of it, or here's the problem with it. You might be thinking, oh, that's great. If I'm in between jobs or I quit my job, I can still be covered until I find a new job. Well, this is the problem is that if you use COBRA, you have to pay not only your portion of the insurance, but your employer's portion of the insurance. So in a lot with a lot of employers pay part of the insurance premium. I'm talking about the monthly premium. And a lot of times the employer portion is much more than what you're paying. So if you use COBRA, your monthly premiums will probably at least double. So a lot of people cannot afford COBRA, and it's actually a better deal if you just go out on your own and get a high deductible policy for the interim. Anyway, just make sure you understand what COBRA is. All right, and then the other thing that I want to talk about that a lot of you probably aren't familiar with is long-term care insurance. That's towards the back of the chapter, and it's towards the end of the slides. Long-term care insurance is insurance that you can buy to help you if you have to go into a nursing home or you need care at home. So let's say that you don't want yourself or your spouse or a family member if they need care to have to go into a nursing home. You want to have care at home. Well, if you buy long-term care insurance, then you can have someone come in and care for them at home, a sitter or what have you, because Medicare only pays for it's like 100 days of someone to come in, home health to come in. It doesn't pay for constant care. But if you had long-term care insurance, you could pay for somebody to come in and sit with the family member, be there 8 hours a day or longer. So these long-term care insurance policies cover someone to come into your home. It also covers if somebody has to go into a nursing home, it will pay for that. So the policies are expensive. Um, they like for just I'll give you an example. My mother has a long-term care insurance policy. Her annual premium is something like $7,000. So it started out being 5,000, now it's around 7,000. And that pays for her to if we were to have to bring somebody into the house, or if we were to have to put her in a nursing home, they would pay, I think it pays up to $350 a day. So that's what long-term care insurance is. Now, it's expensive. It only lasts for a few years too. Most policies will last for only 5 years. You can pay more if you want to last for more, for like 7 years, but your typical policy will only last for 5 years. There's also a waiting period, usually of 180 days. That means if you qualify to go into a nursing home or have home care come in, you have to pay for it yourself for the first 180 days. All right, so now how do you qualify for long-term care? So let's say you or your spouse or family member is or parents or whomever have a long-term care policy, and you want to have them go to a nursing home, or you want someone to come in. How do you get that to happen? Well, they have what's called ADLs. A as in apple, D as in dog, L as in Larry. And that's activities of daily life. So if you cannot perform two of the five ADLs, then they will, the policy, you'll become eligible. You'll have eligible to use your policy. What is an ADL? It's like being able to bathe yourself, being able to dress yourself, being able to go to the restroom, being able to feed yourself. So that those kinds of activities of daily life. So if you cannot perform two of the five, then they will they the policy will kick in. Okay, so just to recap chapter 9, know what COBRA is, know what long-term care is. Just be familiar with how expensive healthcare is in the US and why it is. Okay, now moving on to chapter 10, that is property insurance. So I teach a whole class on insurance, so it's kind of redundant if you're taking this class and the insurance class, so forgive me for that. But this is just really an overview on insurance. So for the exam, the main takeaways are to know what subrogation is, know what the auto policy limits are, and know what are some factors that affect homeowners insurance. So three things you definitely want to focus on in this chapter. What is subrogation, auto limits, uh, and factors affecting homeowners insurance, which I'm going to go over. Okay, so let's start. Let's go through these slides here. Okay, so property insurance uh, protects your real property and your personal property from catastrophic losses. So we're going to be talking about auto insurance and homeowners insurance and renters insurance in this chapter. All right, so let's see here. Okay, so I mentioned subrogation as a test question. All right, so what is subrogation? Well, that just means that, let's say that you get into a car accident, and you call your insurance company, and let's say that you call you can say you call the police, and the police don't say that it's anybody's fault. They don't make a claim that it's your fault or the other person's fault. So you call your insurance company, and your insurance company pays to fix your car. But your insurance company looks at the police report and they say, well, it doesn't really seem like our client was at fault. It looks like the person who hit our client is at fault. So we're going to subrogate against their insurance company. So what it means is they've paid for your repairs, but then they feel that the other insurance company should have paid. So they're going to go after that other insurance company and request reimbursement from the other person's policy. That's all subrogation means, is that an insurance company is going to go after to get reimbursement from the party whom they think caused the damage. So let's say, for example, let me give you another example. You you had some work done on your house. You had some electrical work done on your house. And 4 months later, your house, it burns down. And the insurance company realizes that it was faulty electrical work that caused the fire. Well, they're going to pay to repair your house or rebuild your house, but then they're going to go after that subcontractor or that company, that the electrical company that did the work. Another example is subrogation. Okay, so hopefully I've made myself clear on that. All right. Coinsurance is when uh, that's like insurance for insurance companies. So insurance companies will insure themselves. So if they have to pay out more than more claims than they think, they can go to this company that's basically an investment company that has guaranteed that they will pay some of their claims. That's what coinsurance is. All right, so I'm just going to briefly go over the homeowners insurance. So they have these HO policies so homeowners insurance goes from HO1 to HO5. So if you own a mobile home, if you live in a mobile home or a prefabricated home, you would have an HO2 or an HO3 policy. An HO8 policy is if you own an old home, like an antique home that would be very expensive to repair and not common to repair or rebuild it. And so it's kind of a special case of homeowners insurance. But what I want to talk about is HO5, HO4, and HO6. Those are the most common. So the most common homeowners policy is HO5. That's a comprehensive policy. What that means is that anything that happens to your house will be covered, except what's specifically excluded in the policy. So they'll have these exclusions, like the exclusions might be black mold, might be Chinese drywall, obviously flood. Flood insurance is government sponsored, government subsidized, so they wouldn't cover you for rising water or for flood. But a comprehensive form insurance is called an open perils policy. They'll cover you for any peril except what they have specifically excluded. Whereas if you're up here with these cheaper policies like the basic form, they only cover you for specific things that they've mentioned, like wind, theft, fire. Everything else would be excluded. So that's your comprehensive homeowners policy. That's the kind that you want. Okay, now if you're a renter, it's a good idea to get a renter's policy because as a renter, you have liability. What if somebody comes to your apartment and slips and falls? You could be sued. What if there's a fire, or what if your apartment's broken into and you lose your personal property? Your personal property would be covered under your renter's policy. All right, so let me back up a second too. With all of these policies, condo, renters, and homeowners policies, that's what covers your personal property, in addition to to your house here, the dwelling or your condo. So for example, if you have some tools in your car or your computer, let's say you have a computer in your car and your car's broken into and your personal property is stolen, i.e. your tools and your computer or your computer, your auto policy is not going to pay for the personal property. The personal property falls under your homeowner's policy or your renter's policy. So that's another reason to get a renter's policy, because if you have any personal property stolen, no matter where it is, in your car, on the beach, wherever, would be covered. Okay, so we have homeowners insurance here, we have renters insurance, and then we have HO6s for condos, condo insurance. Because when you buy condo insurance, you're really only paying for your personal property and the appliances, air conditioner and the appliances in the condo. So think about if you go into a condo, you buy a condo and you look around and think about from the paint in. You're responsible from the paint in, meaning the flooring, the countertops, the cabinets, um, the paint in, all the fixtures. The condo association is responsible for the drywall out or the paint out. So they would, if there was a hurricane, for example, they would take all the drywall out, take all the insulation out. They would pay to redo the structure up to the drywall. You would be responsible for the rest. So condo insurance is typically cheaper than homeowners insurance because you don't have to pay to rebuild the structure. The condo association has that. But you're paying for that in the end, you're paying for that because if you own a condo, you have to pay condo dues, and that's how they um, that's how they get the money. You're in a sense, you are paying for part of their policy as well. All right, so that's the basic summary of property insurance. All right, so the first section of the property of a homeowner's policy is talks about the perils. So it would cover you for if it's open perils, it's going to cover you for anything, like I said, except what's specifically excluded. Floods would be excluded, earthquakes, drywall, but Chinese drywall is excluded because that was something that happened during Katrina. It's a corrosive substandard drywall that people were having to rebuild their houses a second time after Katrina. Well, the insurance companies didn't really like that, so now that's actually an exclusion. Same thing with black mold. All right, then the second section of the homeowner's policy is the liability section. So if somebody gets hurt on your property and you're sued, that's it would cover the liability part would cover that. It's usually 100,000 or $300,000, the liability. All right. So this is test question two. What factors would affect your homeowner's insurance cost? Well, typically the type of structure. How is it built? Is it brick? Is it siding? The location of the house, the way that it's built. Some insurance companies will look at your credit score, and if you have a low credit score, you might have to pay more for insurance. So those are some of the factors that affect the cost of insurance. All right, so those you can read the more details here about the property insurance. For example, if you they usually limit um, jewelry and firearms to $1,500 or $2,500. You can get riders if you want to add more and cover specific firearms or specific jewelry. Okay, but we're not going to, that's about all the detail I'm going to go into over homeowners insurance. Like I said, there's a whole nother class. If you're interested, you can take Finance 328. It's available next spring for all you want to know about insurance, but didn't care to ask is covered in that class. Okay, renter's insurance, went over that. It covers basically its personal property and liability. All right. Okay, so I'm going to skip all those details. I just wanted you to have an overview of insurance, of property insurance. Uh, okay, now let's talk about automobile insurance. All right, well, automobile insurance, Part A is the liability coverage. Part B is medical payments. Then you have uninsured motorist, and then you have collision and comprehensive, or other than collision. So liability, medical payments, uninsured motorist, and then so if somebody who hits you and they're not insured, your insurance will cover it. And then you have collision here and not other than collision or comprehensive means the same thing. So if your car's moving and hits something, or or you hit another car, or if your car's moving and hits anything, that's called collision. That's the collision coverage. If something falls on your car, that's other than collision or comprehensive. So if your car has hail damage, that would be other than collision or comprehensive. So that would windshield replacement would be other than collision. If you are just if you're, let's say that your car is parked and something falls on your windshield, that's going to be other than collision. All right. So those are the basic parts of the automobile insurance. Now I mentioned that there's a test question on the auto limits. That's the liability limits. So let me go to that slide. All right. So most policies have limits of 50, 100, 300,000, 500,000. You can pick the limits that you want. So usually you see three numbers. You would see, for example, let's say you saw three numbers and it was 100,000, 300,000, 50,000. Okay, what that means is 100,000 would be paid to each person if you had an accident. 100,000 would be paid to each person in the car or the other car if they were hurt, or you were sued for a certain amount. So the policy would pay up to 100,000 for each person, but the limit would be 300,000 per accident. So if you have four people suing you for $400,000, only 300,000 is going to be paid out. And then the third number, the 50,000, would be property coverage. So if the other vehicle is damaged, your policy is only going to pay up to $50,000 for that. So I just arbitrarily picked those numbers. So let me repeat that. Let's say you have three numbers, and most auto policies have three numbers. And let's say it's 100,000, 300,000, and then 50,000. 100,000, the first number, the 100,000 means they will pay up to 100,000 to each person if you're in an accident. The 300,000 means that they're only going to pay a total of 300,000 per accident. And then the 50,000 means that they're only going to pay up to 50,000 for property damage. Now, in this chapter, they don't even talk about the third number, which is the property damage. They just talk about the first two numbers, the per individual and the per accident. So if you see a test question like that, I think it just has the two numbers. So you have to make sure that you know that. First number is per individual, the second number is per accident. Those are the policy limits. So the policy limits required by law is different for each state, but it's really low. You definitely don't want to have coverage that's that low because you could easily get sued for over the limits. I think it's good to have at least 100,000, 300,000. 100,000 per individual, 300,000 per accident. All right. So I think that's it for the coverage. They go into a lot more detail in this chapter than is necessary. I just wanted really you to have an overview of homeowners insurance, renters insurance, and automobile insurance. You can read this, factors affecting the premiums. You can get a discount. Depends on where you live. Of course, depends on the type of automobile, your driving record, of course. Again, some of these companies look at credit history now. You can get discounts for good grades if you have more than one car. Safe driving gives you a discount. And they do discriminate. They can't discriminate. They don't discriminate by race, but they do discriminate by age, sex, and marital status. And they're just looking at they're looking at the statistics. And so statistically, younger people get into more accidents than older people. Males tend to be a little more reckless drivers than females. So if you're younger, if you're a male, and if you're single, you're going to pay more for insurance. It's kind of crazy when you think about it, right? But if you're a male, you guys out there, you get married tomorrow, your insurance would go down because if you're supposed to act safer when you're married, supposedly. But anyway, all they're doing is, I know it's stereotypical, but they're just looking at the statistics. And so typically, people's driving, you're driving, people have fewer accidents as they age until they get really old, and then it goes back up again. But that's when the DMV will make people come in and they'll actually pull their license when they get to a certain age if they can't pass the test. So anyway, these are the factors affecting the premiums. Um, and that's about it. You don't have to read all these other details. Okay, so what are the main takeaways from chapter 10? Know what subrogation is, have a general idea uh, of property, homeowners insurance or renters insurance or condo insurance, and what factors affect the cost of homeowners insurance. And then for auto insurance, know what those auto limits mean, the first number and the second number on the liability limits. All right, and that's it. As always, reach out to me if you have any questions, and good luck on the final.